Hi everyone, welcome to our latest installment of the AWS and Innovation Bay content series. My name is Rohit Bhargava and I am part of the startup team at AWS, where our mission is to help grow the quantity and quality of startups and founders coming out of Australia and New Zealand. We are extremely excited to have teamed up with the Innovation Bay team to deliver this as a weekly content series that will run every Thursday from 12 to 1 p.m. Before I hand over the mic to Rachael Neumann, just a few quick notes from me. If you aren't already familiar with the Innovation Bay, it is the longest running community group for tech startups and investors in Australia. Their mission is to support founders on their journey from idea to IPO and beyond. They run events and programs across the country and now online, all focused on helping a community of over 5,000 founders, people working in startups, investors, and others to learn, connect, and grow. If you're not already a member, sign up at innovationbay.com. If you're joining us for the first time, I also wanted to let you know how the session will run. We'll start with around 35 to 40 minutes of Rachael interviewing Jackie before we jump into questions from you. Please submit any questions you have into the Q&A tab, which you can find at the bottom of your screen. I'll jump in at the end to facilitate this part of the session. We also have the chat function running so you can engage with others in attendance, but as always, please be considerate of others whenever speaking through these channels. With that out of the way, I'll hand over the mic to Rachael Neumann to kick things off.
Thanks so much, Rohit. Hi, everyone. I'm Rachael Neumann from the Amazon Web Services team. Welcome to our webinar series. And as Rohit mentioned a few weeks ago, we've slowly begun to transition out of COVID-related topics, and we want to provide you with the insights and knowledge that is actually going to help you on the other side of this pandemic and going forward. So each session will be running some deep dives with absolute experts in their field to give the knowledge, the insights, and the frameworks for success that you can take into your own startup. So last week we were joined by Blackbird Venture partner Sam Wong to do a deep dive on pitch decks and reviewing them from a VC perspective. Today we're following up that session looking at the numbers behind the story. We're joined by Jacqueline Purcell, the CFO at Deputy. Jackie recently joined the Aussie tech success story, Deputies, during the outset of COVID-19 after spending 2.5 years as CFO at CultureAmp. She was part of the team over at CultureAmp doing several funding rounds, including their most recent Series E funding of $120 million, which was led by Sequoia Capital, which took them past the $1 billion valuation mark and crowning them as one of Australia's latest unicorns. There are very few CFOs in Australia's tech scene right now with the experience that Jackie brings to the table, and we are so excited to have her join us today. So welcome to the show, Jackie.
Thank you. Happy to be here.
Yeah, great. Now listen, as an early stage investor myself, I often see founders come with extensive projections and forecasts, and I look at those charts and I know that they're largely fingers in the air, don't have much to stand on. So when is actually the right time for these hypothetical numbers and these crazy hockey stick growth curves to really start to be bedded down with more data and rooted in reality?
Yeah, great question. And I should say in general, I'm a big believer that more detail doesn't always mean more accuracy. So if you really are doing projections with your finger in the air, don't spend, weeks building up a, 50 tab super detailed model. You can probably get something as good in 100 lines. So I would say, do your modeling in proportion to your accuracy. Look, early on, if you're pre-revenue, it is important to be able to articulate some scenarios for how your business is going to look. And I think often scenarios are a great way to present it because you really don't know how things are going to pan out, but you want to be able to articulate that there is a big opportunity here. But certainly there are things you can put some more meat around. So absolutely validating the market size. And I think here, what is your real market? So being able to demonstrate that you know that well, who are your buyers? What companies are they at? How will they think about value in terms of the product that you're trying to sell? So, before you've got customers, I think you can put a lot of teeth around those things. Once you start getting customers doing pilots, ideally they're paid pilots. Be really careful of just giving your product away for free early on. But once you start getting customers, then you can start putting some more meat around your projections. Case studies, if you've only got a handful of customers or less, case studies are a great way to start to demonstrate how the economics of your business are going to work. And obviously, as you start growing, the more revenue you have, kind of the more robustness you need in the numbers you're presenting.
Yeah, and you make such a great point because, I look at those curves and I don't think, oh, I'm looking at this because I know that in December 2021, they'll be at 100 mil revenue. I kind of look back and I work backwards and I think, what would I need to believe in order for that to be true? And as you said, thinking about both the market or what kind of traction would I need to believe, and if that feels reasonable, that we're kind of triangulating those figures.
And you can tell me if I'm wrong here, but I think it's actually less important. The numbers that you put down on the page are less important than actually being able to articulate a business plan and case that makes sense. So like, do you understand actually what level of investment you're going to be required to deliver a certain level of revenue? And do you understand what the components of that are? Like, are you going to need a marketing team? What sales infrastructure are you going to have to build out, or are you going to use partners? I think what you can demonstrate is you understand how the business model is going to work and the elements that you need to piece together. And then if that makes sense, that almost builds more credibility than the numbers.
100%. And it's funny sometimes, I see founders or decks that kind of just forget some business fundamentals, i.e., revenue minus cost equals profit. Revenue comes from both customers and price, and just understanding those basic levers that they can pull. So that brings me to my next question, because so many startups, or I guess the airtime is spent focused on the customer problem or the product and solution itself. And yet all of these things are only possible if you have cash, if you have revenue, and if you have a good understanding of the finances. So when do you see companies starting to actually pay attention to this? And when should they pay attention to this if it's not the same point?
Yeah, I think it's actually interesting because I suspect, and actually we've got some early stage founders on the call, early on you are literally existing off the smell of an oily rag. You have no money, you're putting your life savings into it. And it is amazing how scarcity can drive focus and what people are able to produce and accomplish with so little. I think the real danger point actually comes when you do start to raise money, and when you have been existing with nothing and being really scrappy. Let's face it, any amount of money that you raise is going to seem like a lot of money. And it's at that point that I think founders can often too early celebrate the success of that first fundraise and then lose sight of the fact that until you are profitable, cash is like the lifeblood of your business. And I think a lot of companies make the mistake of doing a raise and then losing sight of how much cash their business is burning. And I would say that's kind of the point, to double down. And this doesn't need to be complicated. Like, I think, as you said, this requires primary school math. Cash is literally how much you're spending and how much you're receiving, and when are your payments happening, and when is that cash coming in the door. It's really easy to overcomplicate finance, and we'll get onto some of the efficiency metrics and SaaS terminology. But at the end of the day, as a founder, if you've got a good pulse on how your cash is moving in and out of your business, you'll be able to make good decisions. And ideally, what you want to be able to do is kind of like, you're running a marathon, not a sprint. And what happens, I think, is people raise money, they go on a complete hiring spree, end up spending that money like 5 times as quickly as they'd originally planned, and then they're faced with having to do a fundraise way sooner than they thought. It's just a vicious spiral. So I think, as a founder, you can keep an eye on that cash, and it is really simple. You should always, at any stage, you should be doing that, in my mind.
So, I guess that brings us to the next question is, a founder should always have her or his, finger on the pulse, line of sight into cash, or just the basic mechanisms of how money moves in their business. When should they level up and bring on a CFO like yourself? Yeah. What is the right time?
So you definitely don't need a full CFO to keep track of your cash movements. Like, a good bookkeeper will help you do that. A lot of people have an outsourced accounting finance function early on. Make sure you're getting that insight from them. So certainly you don't need a CFO to do that. I think in terms of the right time, it's just when it really a few things can trigger it. One is just complexity, and that can come from size. It can come from number of customers, number of employees. There's a whole bunch of triggers, but I think when the complexity of your business starts to get such that as a founder, you're losing control, or you're having to spend a lot more of your time on tasks that you just don't get joy out, or don't feel like you're the best value add, or you're ignoring a lot of tasks that need to be done, and you feel like you don't have a pulse on some of these really critical kind of foundational aspects of your business. Like, that's the time to bring in a founder. Often I think CFO, sorry. Often I think that tends to be somewhere between 100 and 200 employees, $5 to $10 million of revenue. It could be earlier if you've got a business that's more financially complicated, like a fintech business might want to bring someone in earlier. If you've got a relatively simple business model, you may be able to push that out further. So that's, there's no magic formula, but I think those are some markers that is about when it makes sense to bring on a CFO.
Great. And listen, I can imagine for many founders, bringing senior leadership in is an important transition point as they begin to mature. So like with any role with teams, there are different flavors of CFOs. And, I imagine there are folks that spike in different areas. I think there are lots of different backgrounds that CFOs come from. And, we'd love to hear more about yours. But what are some key skill sets or capabilities that a potential CFO should have across the board? And how would you identify specific characteristics that you might need in your business? So there's a lot in that question. So let's break it down and we'll go slowly. So first, I just want to hear your story. So how did you become a CFO? So take us through your career journey, and then let's talk about the different flavors, and then we'll give advice for founders on how to pick the right flavor.
Perfect. So I came almost to become a CFO of a startup by accident. I did commerce law at Sydney Uni, spent a couple of years at a law firm. I kind of had the traditional path for a long time. I went and did an MBA in the States. So I spent 2 years studying over there, which was amazing. Like, it's kind of ironic that I spent 2 years, I did my MBA from 07 to 09 in Silicon Valley, yet I then decided to go work on Wall Street for 8 years. So anyway, don't know what I was thinking at the time, but I spent 8 years at Morgan Stanley in New York doing M&A, which was amazing in some respects and kind of not in others, but it definitely taught me a lot about different types of businesses and how to understand a business model quickly. I learned a lot about leadership and what makes an effective leadership and team. I spent a lot of time with different executive teams from various companies, and I got to the point where the kind of, the path at Morgan Stanley was clear. I was doing well. I could have stayed in New York and stayed in that path, but I really wanted to do something where I had more connection to my work and more ownership, and, I was kind of more directly influencing commercial decisions rather than just doing deals for other people. And I also, ironically, got homesick and didn't want to have a career I didn't want to spend the rest of my life in the US without having some more tangible connection back to Australia. So I took a sabbatical year, which I highly recommend if anyone's having kind of a crisis of career, and had an amazing time traveling, and came back to Sydney without a job and without a lot of connections in the startup community, actually. But I knew
when you and I met, is that right?
It is around that time. So I didn't know, I didn't have I want to go be a CFO. I knew I wanted an operational role. I wanted to be at a fast growth business. For me, I was looking for a company that had some traction. Like, I knew I wasn't necessarily the person for a really early stage business. I was interested in that scale up phase. And I wanted a business that was global. I went to the Sunrise Festival that Blackbird hosts, networked by accident and met, I think Didier, who was the CEO of Cultrant, was a speaker at that event. So I heard him speak and I thought his story was amazing. And if you haven't heard Didier speak, he's a phenomenal speaker, super inspiring. But by accident at the cocktail hour, I met Nick Crocker, who's a partner at Blackbird. And I was telling him my story and he's like, oh, you really need to meet Didier. He's looking for someone just like you. And Blackbird connected us, and Blackbird had no idea who I was from that. Like, I literally were having a drink, but we connected, and it was very serendipitous. And what I was looking for was exactly what Didier was looking for, and neither of us knew exactly what the role was, but we knew the elements of, I knew the elements of kind of the company and the role I was looking for, and he knew the elements of the person he was looking for, and it matched up. So I came in kind of, I didn't initially have the CFO title, but I had, my kind of mandate was to help manage the growth of the business and the finances that sat under that, as well as a bunch of other operational stuff. So legal, risk, IT, security, really any kind of company problem was what I stepped into. So that's how I came to be in this type of a role.
And I think a lot of people might wrongfully assume that the CFO role is just, the bean counter in the back, but often that role, as you mentioned, kind of takes on a lot of internal teams as well.
Totally.
And
look, I think it can, the type of, so you touched on, there's definitely different types of CFOs. There are ones that have more of kind of a traditional accounting or deep finance background, and they've grown up in finance teams and organizations and very technical, and there's definitely a role for those type of CFOs. And then there's ones that probably, I would put myself in that category, more operational, more strategic, kind of more, I'll say, commercial. So I'm not an accountant. I couldn't post a journal, but really think about how like the financial and the business model connect. So if you're someone who has a great kind of COO or operational person in your business, you might find that you want a more technical finance person. Or if that role doesn't exist, you might be able to get someone that for a period can kind of span both. So I think sometimes the HR function is an interesting one, and I can talk about this later, but how that connects with the finance function, that's another one that you could potentially think about putting together, because I think it's often misunderstood how critically interlinked those two functions need to be in a business.
We're going to get to that in a minute, but let's talk about everyone's favorite topic, and certainly the topic that all of our listeners' ears perk up on. So let's talk about fundraising. So you've been through multiple funding rounds through your time at Coltramp. At CFO, as the CFO, or in the role that you played, tell us about the process that you go through with the company to prepare for a funding round. And because you've been through a few, let's actually take it round by round and tell us what changes, what stays the same. We know that there's this like whole hidden timeline and all of this work that happens behind the scenes. So let's kind of throw the curtain open and see what happens.
So the first thing I'd say is if you're only starting to talk to investors when you need to raise money, you are way too late. Look, you'll make it happen, but ideally, you're getting to know these people well ahead of when you're looking to raise money. And there are, as I think you certainly know, there are all sorts of investors out there, and the value they will bring is really different. And it's really important that you take the time to kind of get to know them, to understand how they invest, what's important to them, how they will support you, do your diligence on them, understand, speak to other founders that they've invested in, and give them a chance to likewise understand you and how you operate. And the longer that you allow that period to happen, the better you're likely to find that right match. So, whether you're a founder or you're a CFO or a finance person, kind of nudging your founder to like, okay, we've got to start thinking about this. Definitely like start those meetings as early as possible.
Right. So do you work backwards from runway? You say we are going to run out of money on this date, and then work backwards on how long you think it'll take, and what should be the magic number for how many months you go back?
Yeah. Look, ideally, I think you're starting your fundraising with 12 months runway. Like that's so it's a little bit like a piece of string. Fundraising rounds can happen in a matter of like hours. And I think companies like Canva have completed rounds in like 24 hours. And obviously, it's great if you're in their shoes where you have like, there's a ton of competition. You've got just a great business with great metrics. You can set a timeline like that. And then there's rounds that can take months. So going into it, you don't know how long it's going to take, and you don't want to be in a position where you're down to your last 3 months of cash and you're really backed into a corner, because at that point you've got very little leverage over the terms of your fundraise, and you're very much a term taker than a term setter. So 6 to 12 months runway, but closer to 12 is better, which means you want to be having conversations with investors, as early as 24 or 18 months ahead of those rounds. And look, once you've decided that you're going to go out and raise from venture capital investors, and once you've done your first round, I feel like that conversation with investors should almost be a constant conversation.
That was actually my next question. So look, how did Culture Amp, keep in touch with investors, with what cadence, with what frequency, and quite frankly, with what transparency to tee up so that when that B round is ready, it goes quickly. Yeah. There are no surprises.
So Culture Amp had already done a couple of rounds before I joined. So one of the things I did with Didier when I joined was just get like the download of which investors he'd spoken to in the past that he knew well, that he'd liked, what feedback he'd gotten in the past. And then I just set up like a really simple Google sheet, just logging these activities. So we had kind of a central place that we'd record conversations. I made sure that I was part of the conversations. Like, again, they wanted to hear from Didier, so I was often listening, but you learn so much in those conversations about what matters to investors, how they think. No offense to the founders on the call, but you often get a better read of how the level of interest from the investor, because you're observing the conversation rather than
and founders are notoriously optimistic, right? So everyone
correct.
Loves them and their company.
Correct. So if you are a founder, like bring your finance person into the conversation and just have them there to observe. It's also a great chance to ask questions about how their investment process works, how they think about valuation, how they think about diligence, and it's really hard to ask how they think about valuation when you're trying to ask them for a term sheet. So the time to kind of ask all of these questions and really try and extract knowledge from them is early on, kind of before you're ready to say, okay, we're looking to fundraise. And we were always pretty transparent, which was like, look, we're not looking to raise money in the next 3 to 6 months, but in Q1 next year or Q2 next year, we're likely going to be kicking off our process. So we probably stay in touch with investors quarterly. Sometimes it's an email. Sometimes it's a 30-minute check-in call. And look, we tended to have kind of like loose tiers about investors that we thought were a really good fit, that had expressed really good interest in the company. And we probably spent more time with them. And I think that's important because you do, like, as a founder, you have to, and any leader in a startup, like, time is really scarce. So you want to make sure you're spending your time with the people that you feel most aligned with and you think have the highest likelihood of actually becoming investors in your business.
And Jackie, sitting in those meetings, either observing or participating, what part of the pitch or the conversation did you find investors are most keen to kind of deep dive in? And did anything surprise you where it was actually super important to them and you didn't know, or you thought it'd be super important and it wasn't at all? What are your observations from kind of inside those meetings?
So inside those meetings, it's not the financials. Actually, it's 3 things. And again, I'd love to hear if you have a different take on those things. But one is it's still the founder. It's understanding what the founder is like as a leader and how authentic their vision is and their connection to the mission of the company. So it's the founder themselves, and I think that's the top one, and the thing that probably always have surprised, well, not probably surprised me the most the first time I went through a fundraising with DDA and Culture Amp is there was no question that they were backing him as much as they were backing the company. And so you don't want to get in the middle of that dynamic because it's a super important one. The vision is really important, and being able to articulate it in a tangible way. So make it sound real, and then just the market opportunity. You know, VCs are looking to back businesses that have big market opportunities, and then I guess maybe a close, well, related to that, but is this company, does this company have the potential to be a market leader in that big market? So I think those are the three things that people really wanted to understand in those meetings. I feel like the financials were then, once they'd validated those three things, it was like, okay, now let's actually see what sits below it, and do you have the substance to back up the story?
Yeah. And I mean, so I think it was the round before last with Culture Amp, Nick Rocker from Blackbird Ventures came onto the board.
Yes.
Does that change the dynamic once you have a major investor actually sitting on the board? And from, you know, your point of view as the CFO, did that change the way that you had to operate?
It not real. It definitely changed the dynamic of the board meetings, as does, and we had a series, we had an independent board member join as well as a Culture Amp, and it's definitely different, definitely a different dynamic when you have an independent join versus a new investor. So we had Nick join after the D round, and then actually Steve G from Sequoia didn't join formally, but came on as a board observer, so he was often in those meetings. Look, I think as a CFO, it makes you want to, certainly inspires you to raise your game, and you've just gone through a process where you have articulated a story in numbers and a plan to investors, and then you take their money, and then you go to the first board meeting, and you have to kind of be able to reconcile the story that you've told with the reality of the business. And look, a fundraising process is a marketing process. You know, you want to present I'll say a more positively leading view of the company, but still one that has credibility around it. Like you're not there to paint the moonshot picture that has no basis in reality. But remember, like once you take their money, you're exposing your whole business. So you have to, I think, as a CFO and a founder, be able to kind of back up the story you've painted in the fundraising process with the reality. And so that was for me the biggest, it's probably a personal thing, but that I always wanted to, if anything, like hold up my end of the bargain and deliver results that lived up to the picture we'd painted in the fundraising process. And if not, be able to explain it. And look, I think Nick's he's a fantastic board member, huge champion of Culture Amp, asks really tough questions, but also knows that it's not just like, there are things that come out of left field, and coronavirus is a great example, and not everything goes to plan. So he's like super supportive, and I think building that relationship so you can have that active dialogue is really important.
Yep.
And ideally, you're speaking to your board members between board meetings, like you're keeping an active dialogue. If you ever get into a board meeting and there's a surprise or the conversation goes the wrong way, like you haven't done your job to have that dialogue be open.
Yep. Let's talk about the recent months. So you've talked about curveballs. I think the whole world has been thrown a very large one in the shape of a very small and mighty virus. So in the recent months, I think many businesses have been forced to rethink their strategy. And, maybe the old startup adage of growth at all costs is being reconsidered, whether it's the funding environment or just, cash being king right now. And so there's constantly this, I think in all times you need to think about the trade-off between growth and profitability. But what do you think is important right now, and what is the role that you're playing in helping to drive this balance between growth and profitability.
Yeah, and look, it's a conversation that we had all the time. I had all the time with Didier and the other founders at CultureAmp, and it's a conversation that when I joined Deputy has been front and center. And I joined Deputy, remember the date, it's only 3 months ago, but it feels a lot longer, on the 16th of March. So in the middle...
3 months, Jackie, and...
And I don't know if everyone can like cast their minds back to that time, but it was like no one knew what was going, the whole kind of world felt like it was in free fall because no one knew how this was going to pan out.
Well, and that's exactly the number. I remember one of our first guests, Patrick Llewellyn, for his date was March 12th. So he said March 12th is when they looked at the dashboards and it was a free fall. So yeah, what a time to start a new job.
So yeah, it was, I wouldn't recommend it, but I'm someone who looks for the silver lining, and certainly the professional growth I've had and learning in the last 3 months has been huge, and I know that will pay dividends in years to come. So anyway, I look for the positives in all of these situations. So yeah, go on.
Well, let's talk about just that trade-off. So you say you're constantly having that conversation. Yeah. How should the leadership team think about, is this a growth phase? Is this a profit? I always joke that startups grow like children, where like sometimes they get really chubby, then they have a big growth spurt and they'll thin out, then they kind of get chubby. So when should a startup know that it's, time to get chubby, time to get tall? How do we think about this?
Totally. And look, and this is where, investors and board members can be really influential, and that was probably something that the conversation for my first few years at CultureAmp, most of the conversation in the board was around growth. Like that's what we were talking about, cash flow and burn rate. Yeah, they wanted to know we weren't being stupid, but that came second to growth. And I think part of the reason for that is CultureAmp at that time and really still was growing like in top quartile growth metrics. So the investors knew that if we kind of kept this pace, like the funding would flow. So I think there was, and look, the VC funding markets from the last 3 years have been really strong. So definitely my last few months there, I think not just specific to CultureAmp, but more the broader VC market. We saw a lot of these really big, flashy tech companies going public, and the scrutiny over business models and how long you can operate in a cash flow negative position and how sustainable those things are started to come to the forefront. So I think what is important is that you understand, whether you're a founder or a CFO, you understand those inflection points. So how big do you need to get to become cash flow positive? How long is that going to take? Look at your unit economics. Similar.
Next question. So like founders think about unit economics, and it's a very, I think, a pretty important thing to have a grasp on, because if you have a negative unit economic, it means you're literally cutting yourself every time you acquire a new customer. So talk to me about unit economics. How should, let's just kind of give a masterclass right now to all the founders on the call. What is it? How should they think about it? And what are some of the magic metrics that you think about around unit economics?
Yeah. And look, there's a few, but effectively when you're thinking about unit economics, you're looking at how much does it cost to get a customer, and then how valuable is that customer to you? And it's the relationship between those two things. The formulas for calculating all of this are really simple. The actual calculation of them, though, can be really, really complex and very nuanced depending on your business. And it's really easy to construct these metrics to tell the story that you want.
Big cost buckets.
Or not allocate, you might have your salespeople traveling every week to, not now, but in the past, to see customers, and you're not putting travel into your cost of acquiring customers. Don't fool so the lesson is, don't fool yourself with these metrics by being cheeky about how you calculate them. Be really thoughtful, like what actually is it, like kind of, it's important that you understand them and you understand them in the context of your business, and you include those costs that that are critical to driving customers. And then you also understand the value of customers that you have, like how long do they stay with you, how much are they paying you, how much support do you have to put around that customer to make them successful. All of those things are really important. And a bit like the conversation at the start around cash, and early on, founders and startups are super efficient with their cash, and then they raise money and become less efficient. It's kind of the same story with unit economics. I think people get so fixated on chasing growth that they just continue pouring money into a funnel, and the marginal cost of acquiring each customer keeps going up and up. And it's really easy for your unit economics to deteriorate quickly. And so what I try and how I try and think about growing versus being profitable is growth within kind of growth in the context of keeping things like your basic unit economics in certain ranges. So yeah, we'll keep growing as fast as we can, so long as we can keep our payback period less than 18 months, which means that it takes me 18 months to get enough revenue from a customer to cover what it costs me to buy that customer, for example. So there's SaaS CFO is a great website, by the way, if you want to kind of understand these metrics and read them in detail. But a really easy one for founders and non-finance people to understand is the magic number, which is simply how much new revenue are you getting relative to how much you've spent in sales and marketing. And you want to try and keep that number around 1. So if you're, spending $100,000 in sales and marketing and you're only getting $25,000 of revenue, you probably got a problem. But that's a really super high level, but I like it because it's a good general hygiene number that tells you how far or close you are from operating efficiently.
Yeah, I heard you talk about kind of cost to serve, and that once we have customers in the door, not all customers are created equal, and some customers are extremely expensive to serve, either because they use support services or they always seem to need help, and then others, you get them in and they're kind of set it and forget it, and we love having those customers. How, as whether it's the CFO or like who on the team should be looking at segmenting customers to understand the profitability of each customer type, and how important is that?
Yeah, and look, this is a really important conversation to be having with kind of founders and the broader leadership team, because particularly when you're early on and you have a really big prospect that's going to bring in a ton of revenue, it's like, oh my God, this could be like game changing for us. But the flip side is they require a ton of customization, or they're going to take your product roadmap in a completely different direction than where you were going, and or the infrastructure that you're going to be required to serve them is so big that it actually, despite the big top line revenue number, in often cases will cost you more than that to make this successful. And it's, I think, one of the hardest decisions that early on founders and companies need to make is whether to take on a customer like that. And I can tell you that it's still a conversation that is happening at companies like Culture and Deputy, who are now in the tens of millions of revenue, as they grow, like what are the right customers to bring on? And I think that's where having a clear vision, having a clear roadmap, if you're building a software company, understanding how you're going to handle the service side, because again, it's really easy to end up becoming a service company, and that has a very different margin and valuation profile. So I feel like I've waffled.
No, I think
now,
that
but
it's so important, and I think that to your point, that's why we leadership teams need to really be able to crisply articulate that vision. And it's just as important to say what you won't do as it
Correct.
is what you would. And especially when, as you get bigger and you have one team that's involved in acquiring the customer and another team who's involved in serving the customer, we can sometimes get some bad dynamics where people, are incentivized to get customers, toss them over the fence, and kind of don't feel that ramification. I know that when I was at Eventbrite, an important change for us, and this is kind of getting quite down to the nitty gritty, but because the team that serviced accounts were different from the team that acquired customers, and those who acquired customers had quota and they were rewarded, and so it's hard to ask a human to behave against their incentive structure, and so we actually had to create clawbacks of some of that some of the commission if they were the wrong type of customer. And so it's so important for us to think about like the whole ecosystem within the company to get these numbers right.
Yeah, and I don't know if it's well known, but there's certainly blogs about it. And again, I know that as in Culturam's case, as the company is growing, again, how you are setting up your compensation incentive structures is something that you need to look at kind of constantly as you're growing, but certainly for most of Culturam's history, they didn't have a commission model for their salespeople. And so that problem that you talked about was one that didn't exist because, everyone had a flat salary. So it made it really easy to align teams cross-functionally when thinking about what the right customers were to bring on. That's a pretty, I don't know whether controversial is the right way, but a pretty unique approach. Like there's not many companies that think, I'm going to set up a sales team without commissions. But if you're interested, again, Didier's got some blogs on why they took that approach. And it certainly had some benefits in tackling that problem. But look, I will say in terms of that aspect, I think there's no perfect system. It's almost like how do you suck less at it than anyone else? But it is really important that you understand what you're incentivizing your team and the behaviors that come from it. And if you're driving like we just need as many users as possible, is that creating other problems for you in terms of are people discounting too much, or are they giving away your services, or whatever it is? So it's definitely important that you understand what behaviors will come from the way that you design your incentive structures.
So, that's a great just reminder of how much, human behavior or human element there is, in business. And even, from the CFO perspective, you had started to touch upon the connection with HR earlier.
Yeah.
And so I want you to elaborate on that. And also I want to, you have a very specific story that unfortunately you had to be involved in at Deputy, given the current conditions. You've come in thinking about, the profitability and just the cash conservation. You've had to make some pretty difficult decisions at Deputy. So can you tell us a little bit about this specific situation, and then let's talk more broadly around that interplay between finance and, people operations?
Sure, absolutely. Look, I think, so as I said, joined Deputy in mid-March, and it was when coronavirus was, the world was in free fall. And what is actually interesting, Deputy, for those who don't know, is a workforce management platform that helps businesses roster, schedule, and track their time of primarily shift-based workers. A lot of Deputy's customers are in hospitality and retail, those industries that were really directly impacted by the lockdown and restrictions on business activity. And so there's really interesting data that kind of you can see the change in customer behaviors. And for those who are trying to figure out what shape the recovery will be, I can tell you that we're definitely seeing that Nike swoosh, like the change in customer behavior in that the back end of March and early April was really dramatic. And so I came on board, I think the degree of uncertainty in that time was as high as it would ever be. And Deputy's lucky to have an amazing board. And one of our board members is Alison Dean, who's on the board of Westpac, on the board of Cochlear, Ramsey. So she was kind of bringing insights from these really, big companies with a lot of, Westpac's economists, all these people, and being able to bring that insights into the conversation with Deputy. But everyone, no one had the answers, and no one knew exactly what was going to happen here around the world. So what can you do? You control what you can. In my case, I had to get up to speed on the business model really quickly. And what we decided to do was to think about, okay, what are some scenarios for how this could play out? Even in a really bad scenario, how much do we need to shrink our cost base to survive? And by survive, I mean to have kind of 24 months of runway, because again, we didn't know what was going to happen with the funding markets. But basically, it was the mindset was, if almost the worst case scenario plays out, how do we need to manage our costs to be in a position to kind of come through this and be able to recover on the other side of things? The good and bad, and I'll talk about the people thing, but for technology businesses, 60-70% of the cost base is people. So when you're forced to shrink costs, you can get out of some leases, you can turn off a few SaaS tools, you can cut back on your marketing budget, but really to really change your cost base, unfortunately, it requires changing your headcount levels. So we tried, so kind of in that context, I think as a team, there are a few things that are important to us. One was that we were kind of tried to give people as much information as we could as quickly as possible. It was such an uncertain time. We wanted to be as generous as possible for those people that were impacted. And we didn't want to be in a situation where we were going to have to do multiple rounds of layoffs. So, we took the decision to move quickly. I think, these processes are never easy. Definitely learned some things, but I think overall we took kind of a very human approach to the decision. We are actually in, and it's funny now, it's 2.5 months past, it's the positive kind of side of this, we're actually starting to rehire back some of those people. So that's been a really great kind of boost to the business, having people come back into the company. And that's what we always hoped would happen. But it is having to make these decisions is something that kind of comes with the territory when you raise money and you're really trying to grow really fast, and an event happens that stops that growth in its tracks. So I hope that gives some context to how we approached it. And
well, thanks so much also for that honesty. Jackie, we've had too much fun talking. We need to pass the mic over to Rohit with any questions. I know that a bunch of people had asked some questions prior through the registration process. So Rohit, do you have any questions for Jackie?
I do, and thank you for that great session, Jackie and Rachel. So just a quick reminder that we've, in the limited time that we have left, if you have any further questions, please submit them into the Q&A tab, and we'll try and get to as many as possible with the remaining time. Just one quick clarification was the website for CFOs that you mentioned, Jackie. Was that saasmetrics.co?
it was actually the SaaS CFO, and I'm like, so if you Google SaaS CFO, I'll pull up on my phone. There's some those resources are all free. There's really great resources there. So it's www. Thank you. There's really great metrics and models that you can download, and it's a fantastic resource for people who are just learning about SaaS. And also, sometimes I'll consult it if I'm trying to, again, going back to those unit economics, you're looking at trying to work out the lifetime value of your customer, and you're like, do I do churn on revenue or customer number? And anyway, so I won't go down that rabbit hole, but I still refer to it sometimes. So it's a good resource.
Fantastic. Thank you for sharing that. We'll make sure that we also share that out to everyone that registered by email post-event. The next question that I have is submitted by Ariane Barker, who wants to know, what has been the biggest cultural change for you between your roles? And what do you love about working in the startup sector specifically?
Yeah, look, I think I will say, we were kind of touching on this at the end, no question, for those who are exposed to culture and probably know what I'm talking about, but definitely the biggest thing that I took away from my time there is the power of being a kind of culture first company and really leading through people and thinking about the experience of employees and being intentional around your company values and being clear on your mission and vision, and just like the power of that. And so that has been a big thing I've taken away from Culture Amp, and I hope been able to bring a little bit to Deputy. And I think sometimes are surprised when, you know, the CFO's like, well, hang on, before we talk about how much we should spend on rent, let's talk about what experience we want from our office space. But I really think the two are important. And if you get that employee experience right, you bring on the right people, like the financial metrics will follow. So I definitely lead with that. In terms of what I love about working in these type of companies, they're just changing all the time. There are no shortage of things to do. And I think you can get so much experience in a condensed period of time, and you can get so much more deep experience early in your career than you can in a more structured environment. So
we joke that startup years are like dog years, right?
Correct.
7 for 1, which is why I have gone silver very early. But
and now, like, I feel like every time I go to the hairdresser, I need to bring like my next appointment forward a week to get on top of these grays. But like, they're dynamic, they're difficult, like they're not easy places to work all the time because things are moving so much. I have learned to be comfortable in chaos because these companies are chaotic in like all the good and bad ways. And I think you get to use a mix of all the different parts of your brain. So there's a lot of like really hard intellectual problems that you're solving. And then there's a lot of really hard people problems that you have to solve too. So I feel like I use both. And there's awesome people in them. And I think really diverse people like you. Yeah. I love the different, like I've learned so much about engineers and what they like and how they like to work compared to kind of the sales team and how the two connect. So yeah, they're exciting places to be.
We joked, I remember at Eventbrite's office, which was very big and kind of in a ring shape. The salespeople were in the opposite corner from the engineers, and that was very much a proxy for their personalities. Well, Jackie, thank you so much. We are out of time, but this was an excellent conversation. It's always a pleasure to chat with you and learn from you. Rohit's going to take us home, and thank you everyone for who joined us today, and we'll see you next time.
Thank you.
Reiterating Rachel's point, thank you all for joining us, and a big thank you to Rachael and Jackie for that extremely insightful discussion as well. Just a couple of quick notes from me before we sign off. So first of all, we've got school holidays coming up, so we're going to be taking a break for a few weeks, and you probably should think about doing the same as well. So we'll be back with you in probably another 2 to 3 weeks. You'll get notified via social media and by email when our next session is locked in. And also, as a thank you for everyone for joining us, we're providing $5,000 in AWS Activate credits available to everyone who has registered and attended this session. The details and terms and conditions behind this offer will be sent to you via email. Once again, thank you all for joining us. Take care of yourselves and see you in a few weeks.